You swipe your card without thinking twice. It feels routine, automatic, almost invisible. But somewhere, in a server farm you'll never see, a machine just made a prediction about your future. Not your horoscope. Your finances. It knows how likely you are to miss a payment. It knows how likely you are to carry a balance. In some cases, it knew before you did. That sounds unsettling, maybe even a little dystopian. But it's not science fiction. It's the quiet engine running underneath almost every credit card in your wallet. Here's the belief most people carry around: credit card companies just want you to pay on time. They want responsible customers. Good little payers who use the card and clear the balance every month. That belief is wrong. Or at least, it's incomplete. The truth is stranger. Credit card companies don't make most of their money from responsible customers. They make it from customers who carry a balance. Late fees. Interest charges. Revolving debt. That's the profit engine. So the question isn't really, will you pay? The real question, the one the algorithm is built to answer, is, how much can you almost not pay, without actually defaulting? That's a very different question. And it changes everything about how your credit limit, your interest rate, and even your card offers are calculated. Let's talk about how your brain fits into this. Because this isn't just about math. It's about psychology. In the 1960s, a Stanford researcher named Walter Mischel ran what became known as the marshmallow experiment. Children were given a choice: eat one marshmallow now, or wait 15 minutes and get two. Some children waited. Many didn't. Years later, researchers found the kids who waited tended to have better life outcomes across a range of measures. Why does this matter for your credit card? Because swiping a card is the adult version of eating the marshmallow now. It removes the friction of paying. It separates the pleasure of buying from the pain of paying. Behavioral economist Richard Thaler spent decades studying this gap. He called it decoupling. When you pay with cash, the pain is immediate. When you pay with a card, the pain is deferred, blurred, and easier to ignore. Credit card companies know this. Their entire product design leans into it. Tap to pay. One-click checkout. Buy now, pay later. Every innovation reduces friction a little more. Less friction means more spending. More spending means more revolving balances. More revolving balances means more interest revenue. Is this manipulation? Or is it just smart business? Maybe it's both. Now here's where the prediction part comes in. Credit card companies use something called risk-based pricing. It's not new. It's actually rooted in older economic theory. Eugene Fama, one of the most influential economists of the 20th century, helped develop ideas around market efficiency. He argued markets absorb information rapidly and price it in. Banks apply a similar logic to you personally. Your spending patterns, your payment timing, even the types of purchases you make, all get priced in. Miss a payment by even a few days. The algorithm notices. Pay down a balance right before your statement closes. It notices that too. Every action becomes a data point. Every data point refines the prediction. This is why two people with similar incomes can get wildly different credit limits and interest rates. It's not personal. It's pattern recognition running at scale. Here's the counterintuitive twist. You'd think the safest customer, someone who always pays in full, would be the most valuable to a credit card company. In reality, that customer is often the least profitable. Companies sometimes refer to them, only half-jokingly, as deadbeats. Not because they're irresponsible, because they don't generate interest revenue. The customers who generate the most revenue are the ones who stay just barely within the system's tolerance. Carrying a balance. Making minimum payments. Never quite defaulting, but never quite escaping either. Does that mean the system is designed to keep you in a holding pattern? In a lot of ways, yes. Not through malice. Through incentive. The business model rewards it. So what do you actually do with this information? Benjamin Graham, the investor who mentored Warren Buffett and literally wrote the book on value investing, had a principle that applies far beyond stocks. He argued that the biggest threat to any investor wasn't the market. It was their own behavior. The same logic applies here. The biggest threat to your finances isn't the credit card company's algorithm. It's your own relationship with friction, convenience, and delayed pain. Once you understand that the system profits from your delay, you can flip the script. Pay before the statement closes, not just before the due date. This can lower the balance the algorithm sees and report it to credit bureaus, which can improve your utilization ratio. Automate payments in full, removing the decision point entirely. Treat your card like a form of cash, not a form of credit. Reintroduce the friction Thaler talked about, deliberately, on your own terms. None of this requires you to stop using credit cards. Rewards, fraud protection, and building credit history are real benefits. The goal isn't to fear the card. It's to stop being the input the algorithm is optimized to profit from. Now let's zoom out to the bigger picture. This same behavioral pattern shows up everywhere in modern finance, not just credit cards. Think about retirement accounts. The Trinity Study, a well-known piece of financial research from the 1990s, examined how long a retirement portfolio could last using a consistent withdrawal rate. It became the foundation for the 4% rule many financial planners still reference today. The study's core insight wasn't really about the number 4. It was about the danger of behavior, panic selling during downturns, chasing returns, abandoning a plan under emotional pressure. Sound familiar? It's the same battle. Systems and institutions are built around predictable human behavior. The winners are usually the ones who understand the pattern instead of unconsciously living inside it. Now bring this into the present moment. Financial institutions increasingly use machine learning models, not just static formulas, to score risk. These systems ingest thousands of variables in real time. Transaction timing, merchant categories, payment velocity, even the time of day you tend to shop. The prediction isn't just about your income anymore. It's about your rhythm. This is where AI and money intersect in ways most people don't realize. It's not just chatbots and image generators. It's the quiet infrastructure deciding your interest rate while you sleep. Here's the modern mirror. A century ago, banks relied on a loan officer's judgment and a stack of paperwork. Decades later, that shifted to standardized credit scores like FICO. Today, it's moved even further, into adaptive models that update your risk profile continuously, sometimes daily. The tools have changed, the core dynamic hasn't. Institutions are trying to predict your future behavior based on your past patterns, and profit from the gap between what you plan to do and what you actually do. Warren Buffett has said, in various forms over the years, that the stock market is designed to transfer money from the impatient to the patient. The same idea applies to consumer credit. The system is designed to transfer money from the reactive to the disciplined. You don't need to outsmart an algorithm with more data than you'll ever have access to. You need to remove yourself from the pattern it's designed to exploit. Pay in full. Automate the boring decisions. Let friction work for you instead of against you. Every month, money enters your account, and a quiet decision gets made about what happens to it. You can let that decision be automatic, shaped by convenience and deferred pain, or you can make it deliberate, shaped by a plan you actually chose. Your bank account isn't failing to grow because you're bad with money. It's because the system was built to predict exactly what you do next, and profit from it. Now you know the pattern. The only question left is whether you'll keep feeding it, or finally step outside it.